To our MPC broadcast, we continue our discussion with George Glynis and Elise Kruger. Thanks for joining us again. George, let's get back to the issue of the ratings agencies. People saying that if Moody's downgrade us, we'll come out of the World Global Bank Index, index, pardon me, and that will mean a lot of capital outflows. You don't seem to necessarily agree with this.
Yeah, I think it's far too simplistic an assumption that it's just the one equals the other. So let's give you a few mitigating factors just very quickly. Many bonds of South African bonds get traded abroad. There are many holders of those bonds obviously sitting in the likes of London, New York and other financial centres. If an investment grade manager in one of those financial centres sells to another one who's also offshore, it doesn't come via South Africa. It need not be a rand impact at all. It simply gets traded abroad. It doesn't. It's rand neutral, in other words. If there are going to be sales out of South Africa, someone's got to buy it. And so the guys that are selling are not going to want to destroy their market by all jumping into the same exit funnel at the same time. So I believe that already there's probably been some preemptive exit from those portfolios, but equally, if there hasn't, I seriously doubt that it's all going to happen through the course of a day or two. Thirdly, a lot of the domestic fund managers are seeing local interest rates, bond yields, at very positive real interest rates, and for inflation plus mandates, these are very attractive. So there's going to be natural domestic demand from the local fund managers. Then there's issues of big fund managers abroad that within their own bouquet of portfolios can simply adjust and shift from one to the other. There's a softening of mandates for funds abroad that have got defined benefits and that are underwater, that need to try and attract yield. They've been allowed to invest into riskier markets as well. There are a number of factors that combined, when you have a look at all of this, on top of the fact that it is entirely unclear that everybody heads for the exit door at the same time, that I don't believe that it's going to have anywhere near the impact that's being feared at the moment. Perhaps a few cents here and there, 20, 30 cents, but in the broader scheme of things, that definitely hardly changes an inflation forecast.
Elise, things are looking good though. I mean, the governor is saying that average wages are going to increase above 6% for the consumer. That's a good thing. He's talking about lower inflation, generally speaking, an improved rand exchange rate, although the oil price remains, fairly high, but he's not sure as to whether that's going to be sustainably so. The picture does look a bit better. In the fourth quarter of last year, there was an increase of about 20% in the purchase of durable products. Doesn't look too bad.
No, indeed. No, we have revised our GDP growth forecast upwards in the recent month for the reasons which you just alluded to, and we have incorporated 225 basis point cuts in interest rates, in that forecast, but also the lower inflation and the impact that will have on the purchasing power of households. So we think a real GDP growth rate in the order of 1.7% for 2018 is not unrealistic. That is even 0.3 higher than what the SABC has indicated today. So yes, indeed, it does look quite positive. And if the risks, as we discuss here, does not play out as negative as the bank foresee, I think come March they might be slightly behind the curve in terms of stimulating the economy and bringing real rates a bit closer to a better long-term level. So I think by that time we could definitely see a cut if there hasn't been a significant negative play out, which, like we say, could perhaps be over anticipated at this stage.
And just simply explain to the viewers that real interest rates are at the highest they've been in a while. Just explain what that means.
Yeah, that's indeed a measure to show how restrictive monetary policy indeed is. In the world, if you look at the current scenario post the global financial crisis, central banks cut rates to the extent where the real interest rate is actually negative. Stimulating the economy, make it easier to borrow, lower lower and easier, lower cost, to try and get the economy going. So like I've mentioned, we are at such low levels for our economic growth rate. So does it make sense to have a restrictive real interest rate environment? And the Reserve Bank has actually informally, noted that they would be comfortable with a 1.5%, long-term real interest rate. So that shows you that anything above 2% would definitely be considered to be quite restrictive on the economy. And that doesn't gel for me, if you look at the actual sort of dismal economic growth outlook that we still have on the table.
Now, when you look at the various sectors, agriculture has been an important contributor to GDP. What's your prognosis in terms of the sectors that are going to move things this year?
I mean, agriculture always tends to be a big swing factor, and we're going to see how that unfolds through the course of this year, because we've still got bad drought conditions that are unfolding in the Western Cape, and the full effects of that, I think, still have to be felt. So we're going to see how that unfolds. Cyclically, you'll probably find banking stocks doing a little bit better now because of just the general upswing and improved confidence, etc., etc. But it's such insipid growth that when I look across the sectors, it's very difficult to pick clear outperformers and clear underperformers. I just don't believe any of the sectors are performing particularly well. It's more a case of every now and then in agriculture you might get this cyclical recovery, upswing to some degree, but the real fundamental stuff, I mean, we should be talking about growth north of 4%. Then we'd be able to talk about the real strength and cycles of the underlying sectors. As it stands right now, I mean, South Africa is just bungling along. We're bungling along, and growth remains, as I said, fairly insipid. I don't see it improving dramatically, but it'll be better than last year, thankfully. But again, let's wait and see how things unfold. I suspect, just following on from what Elise was saying with the real rates, in the models that we look at to assess resilience of the rand, I can tell you that plays a significant role in adding to the resilience of the rand, which in and of itself is not a bad thing. I would welcome that. But again, I question whether they hold the same bullish view on rand as we do, that we've had for quite some time, and that we continue to hold going forward, at least for the next 6 to 8 and perhaps 9 months. If we're sitting talking about a rand closer to 11.50 or below to the dollar through the course of the next couple of quarters, I tell you, their inflation forecasts are going to be revised down yet again. And I'm talking now probably for about close on the 7th or 8th quarter in succession. So these inflation moderations and inflation beating expectations to the downside month after month after month is a trend that we think continues. It continues through the course of the next few months, partly because we've got a very tight monetary growth environment, partly because of things like positive real interest rates, fairly weak demand levels. I wouldn't take the latest retail sales. I'd take them with a bit of a pinch of salt at this point. Again, I think all we've done now is ensured that March we will be cutting. So perhaps we were a little bit ahead of the curve this time around in terms of the Reserve Bank's curve. But I still suspect that we've got cuts before we have hikes.
Well, let's hope you're right. He talked about 2 interest rate hikes and the third one being marginal. What do you think he meant by that?
Well, I think, the new quarterly prediction model, it's still new, and we probably need to engage a lot more with the SABC people to maybe understand exactly what it means. But as I understood it, they basically work with differential to long-term equilibrium levels. And for the inflation rate, they use the 4.5% midpoint of the target range. So for as long as inflation on average is expected to be above that, the model will signal, in combination now with some of the other variables, that rates will have to be increased. Although in my book, 4.9% headline CPI, while economic growth is so low, is for me an environment to cut rates. Whereas, from the model's point of view, they would like to be closer to the neutral level of 4.5% before rate cuts will be signalled by the model. Now, the model is only a tool or an additional sort of measure to look at in the deliberations. But in a sense, I think that does influence the market. You know, and the plus 3 sort of 25 basis point hikes flagged at the previous meeting had everybody a bit up in arms, you know, sort of not seeing that maybe the scope has opened up for the cut. So yes, I think overall, to me, that's sort of missing a bit of the window that we see by focusing on that.
All right. Well, we've run out of time. So much more to talk about. Thank you very much, both of you, for your time. That was George Glynis. He's head of analytics at ETM Analytics, and Elise Kruger, economist at NKC African Economics. Pardon me. Thank you very much for having joined us. It's the end of our show.